Good afternoon, everyone. Thanks very much for joining the Sterling Planners webinar. Delighted that you've taken the time to do so. Joined today by Jackie Austin, who I'll introduce in the chat or the Q&A, and we'll get to those as we go through or towards the end of the presentation. But with that, we'll get going. Today's a really interesting topic. Looking at, obviously the property market in Australia is always and often how can we utilise our property for a range of things. And one of those today is looking at reverse mortgage options and how you can create potential income streams from your property in retirement. That's one area we'll cover. And the second thing is really looking at how we can help the next generation. So, I've got 4 kids, and 2 of them one of them's just bought a property, one of them's looking, and it's incredibly difficult to try and find something and help them on that journey. So we'll be covering that today as well. Okay, so before we get started, we have to just cover the fact that there is a general disclaimer that we have to say. So anything we say today can be taken with a pinch of salt. But it doesn't take into account your specific needs or circumstances, and the information is quite general. So if you do ask a question on your personal situation, probably best not to answer it in this forum, but we're happy to do so afterwards. Like I said, Jackie's the presenter today, and Jackie's been with the company for a little while now. Quite unique in this sort of mortgage broking and world to have somebody who's equally adept at mortgage broking and finance and financial advice. So she has the ability to look at all aspects of how this sort of fits together rather than just one or the other. So it's quite a unique skill, and she's fantastic for the business and looks after our clients extremely well in those areas. You can see from the slide there, she's got a background in a whole load of different areas. So, we couldn't think of anyone better to do the presentation today. And so with that, I'll hand over to Jackie and enjoy the session. Thanks, Jackie.
Thanks, Nigel. Hi, everyone. Thanks for attending today. So today we're really going to go over reverse mortgage options. There's 3 major options available in the space. We'll look at some insights from the Money Smart website that has some just really great tools and reverse mortgage calculators that anyone can access. And then the second part will be just looking at some family guarantee loans and first home buyer schemes and some updates that have come in now that the Labor government was successful in the recent election. They did make some promises which they've made good on, which really does help the first home buyers. There's been some big changes in that area. So we'll just move to the next slide. So why we thought this presentation will be useful is we have a lot of clients come to us with similar goals, whether it's maintaining a comfortable lifestyle in retirement, just having a home to live in for life, avoiding the need to downsize too early, or supporting unexpected costs, so such as medical, renovations, or helping family. So sorry, we'll move on to the next slide. So what is a reverse mortgage? So loans, previously reverse mortgages were available for clients aged 60 plus. Recent market changes have allowed clients from 55 plus to access equity with their home without selling. There's multiple types of options. So whether it's if you're in need of a lump sum or regular income, or a line of credit where you might want to access a lump sum and then leave some money there where you can draw on at a later point in time. Characteristics standard are normally no repayments until you sell, move out, or pass away. And the interest is compounded over time. Generally, the first type of question I'll ask my client is, what do they need? Is it ongoing cash flow, or do you need a lump sum to complete a renovation on the home, or just holidays, whatever their need is, or they feel more comfortable with. So let's have a look at the different types of reverse mortgages available on the market. So the first one is the Home Equity Access Scheme. So that was formerly known as the pension loan scheme. The government likes to change its names every now and then, so it's now named the Home Equity Access Scheme. With this scheme, it forms part of the age pension. So you can access this once you're entitled to the age pension, so 67, which is now the age pension entitlement. And if you're already receiving the age pension, so the limit that you're allowed to receive on the Home Equity Access Scheme is 150% of the age pension. So let's say you're already receiving 100% of the age pension. That means you could access an extra 50% on top of what you're receiving. And it works on individuals or couples. So whatever the couple is receiving, then they can receive 50% combined on top of if they're already receiving the 100%. You can receive that in fortnightly top-ups. You can receive small advance lump sums, so it could be 26 weeks in advance that you could receive a lump sum. The rate is very low. So the current government rate, interest rate on the Home Equity Access Scheme is actually 3.95%, which is very, very good compared to a traditional reverse mortgage where the interest rate sits at around 9%. Property-wise, you can use an investment property, you can use your principal place of residence. So either can be used as security. And that the application for the Home Equity Access Scheme is done via MyGov. It's actually a pretty forward, straight application that's done via MyGov, and you don't have to be eligible again for the age pension. So you could be a self-funded retiree and you can still access this Home Equity Access Scheme to give you cash flow if you need. So that could be somewhere where a couple, the 150% works out to be around $1,500 a fortnight. So it really could improve your cash flow if that's more so what you're seeking. The second option is reverse mortgage. So again, this is where I would say if you're more so looking for a lump sum to do some renovations, buy a car, take a big holiday, this may be your option. The interest rate is higher on the reverse mortgages. So generally you're looking at around 8 to 9% is the current market rate on a reverse mortgage. There's no major banks that participate in the reverse mortgage space. And even some of the second tier banks don't. They're generally banks focused solely on the reverse mortgage space. Heartland is a big player in the space. And when we move further into the slides from the Money Smart website, I'll show you some other participating lenders within the reverse mortgage space. And then there's the option, which a lot of people don't know about, which is the home reversion scheme. So that's where there's some private equity firms such as HomeSafe, play in this space. So what they do is they actually buy a portion of your home. So let's say you sell off 20% of your home to the private equity firm, and then they obviously capitalize on the future value growth of the property. So there's no repayments as such, there's no interest rate as such, they really just own a portion of your property. All of these styles of lending, they have like a no equity protection. So especially with the reverse mortgage and the Centrelink scheme, you'll never go into negative equity and they can never make you move out of the home. So I think that just offers a real good security for people when they are looking at accessing these funds, to make sure that even if they do use up all the equity in the home, they'll never be required to move out or end up in a negative equity position on these types of arrangements. So I do have just some more details on each of these slides. So the Home Equity Access Scheme is obviously government-backed loan. It's available to both age pensioners and self-funded retirees, which I've already stated. You can access the funds fortnightly, a lump sum, or a combination of both. You retain full ownership in the home. So what happens is they actually put a caveat on your title deed. just to obviously say that someone has a financial interest in the property, but you still maintain the title deed of the property. The interest rate is charged at 3.9% per annum. You can repay this loan at any time as well, or you can repay portions or part of the loan. It's a very flexible facility. The option is obviously ideal to supplement income, so it's very good for cash flow. And yeah, you can use either your principal place of residence or another property to support the security of the loan. And then if we move on to the reverse mortgage, so offered by banks and private lenders, generally good for lump sum regular income streams. Again, as I said, the interest rate's a lot higher here. It's around 8 to 9%. So ideally, the Centrelink loan is the best option just because the rate's so low, but it's obviously the funding that you need. So if you need lump sum funding, and I always say, like, if you're accessing a lump sum to do a renovation, you might go down the reverse mortgage path first, because obviously if you go down the home reversion scheme, you're actually improving the financial value of your property. So you may want to do the reverse mortgage first, where you undertake the renovations, and then potentially, if you like the idea of not having a loan and just selling off some equity within the property, you go down the home reversion scheme as a secondary option after you've made the improvements to the home. So I just always say, obviously, if you're borrowing money to do improvements into the home and you're selling off a portion of your home to do those improvements, then they're going to significantly financially benefit from those renovations. So yeah, you may be better off doing the reverse mortgage first and then switching to the home reversion scheme, selling off a portion of the home without having a loan attached, which makes some clients feel a lot more secure. Now, if we move on to the MoneySmart website, actually has a really great reverse mortgage calculator to show you what percentage of ownership you would be giving up over certain periods of time once you access a reverse mortgage or access income as a ongoing cash flow. So, sorry, this looks a bit that you can't really see them lenders from the screen here. As I said, we are sharing this slide. So there is a list of lenders on the MoneySmart website that do participate in reverse mortgages. And the calculator gives you a really great document that you can print out and keep for future. So this is what the calculator looks like on the reverse mortgage calculator on the MoneySmart website. So you enter in the age of the youngest borrower, the value. I've just used $1 million here for simplicity. Obviously, if your house is worth 2 million or 3 million, then the numbers will just equate to that value. So we've put in that the house will grow in value 3% per year, and I've put in an interest rate of 9.5%. So this is utilizing a traditional reverse mortgage, taking a lump sum, put establishment fees of $1,500 and then ongoing fees of $10 per month, and accessing a lump sum of $150,000. So on the Australian Institute of Health and Welfare website, it does show some life expectancies. So at age 65, a male will more than likely have an additional, on average, 20.2 years. So their life expectancy is 85.2 years. And for a female, 87.8 years. So what we're looking at here is, if you do access $150,000 from your $1 million home value, what does that look like over the years after accessing those funds? So obviously, if you're accessing $150,000 of $1 million, that's 15% of your home equity that you're giving up within the loan. In 5 years, you'll loan 79% of your home. So you'll owe the lender $243,000, but your home equity would be $915 with that 3% growth. And obviously, as we go through the years, you start changing. So by the age of 80, you'll own 60% of your home. So your home equity would be $929,000. So still a large inheritance there that you'd be able to leave to your children, family, pets, whoever you choose to leave that to. And you're falling in line with the average, with the life expectancy statistics of the age 80 range. As I said, if you do live beyond 80 or beyond 90 or beyond 100, you've got a guarantee you're allowed to stay in the home for the rest of your life. They can never make you move, and you'll never have negative equity in these situations. When you do pass away, though, there's generally a 12-month window where the property has to be sold, or the debt needs to be cleared. So either of the two preferences with whoever is managing the estate. So there's normally a 12-month window where anyone that's living in the house needs to exit, and the property needs to be sold, and the debt needs to be repaid. I think we're going pretty good for time. Did we want to, Nigel, we want to do some questions for the reverse mortgage before I move to the family guarantee loan, or just go to the family guarantee loan and then do questions at the end?
No, you can certainly do questions now. So if anybody has a question, they can raise their hand. It's that little hand button at the top there, and then we can just give you access to the and to ask a question.
So Jackie, there's a question from Mark Davies. I just want to confirm we will get this deck post the session so we can read the details after. Yes, we can share that. Absolutely, Mark. There was another question from Sam Mehta. Can reverse mortgages be assessed from investment properties?
Yeah, so that's either security. You can use any security that you like, whether it's a investment property, holiday home, or your principal place of residence.
Okay, that's the only question I've got so far.
Okay, rather than the question, maybe just a comment, Jackie. Would it be fair to say that, obviously, depending on your family situation, things out, that your family is expecting on your passing 100% of the value of your property, and they end up getting 60%, or has a big debt to cover, that that it shouldn't necessarily be a surprise. It should be something that you sort of make your family aware of. Obviously, depends on your situation, but it would be a bit of a shock to some people, I'm sure.
Yeah, we always discuss this. Like, obviously, it's ideal to let your children know that this is the path that you're going. And that could potentially open the door to maybe your children buying some equity into your property as well. So it's just obviously every family dynamic's different, and discussing financial matters with kids is just not favourable in some circumstances, or parents don't feel the need. But yes, we're generally in occurrence that talking with the children is always a good discussion, and it could be a good way to lead into that they buy some equity in the property, or support some cash flow for the parents in retirement, knowing they're going to get an inheritance. I think someone just raised their hand. Was it Sean?
Sarah, I think it was Sarah. You might have to unmute yourself, Sarah, if you'd like to ask a question.
I think I've done that. Can you hear me?
Okay, there we go. Yep.
Yep, we've got you.
Look, Jackie, thank you so much for this deck. I'm just feeling a bit of a numpty here on the reverse mortgage calculator. I don't see what's in it for the owner of the property. I just don't. When you owe to the lender, so the lender is going to give you 150,000,
Mm-hmm.
and then in 15 years you're going to owe them 600,000. It
Yeah,
just
like where
seems, it feels literally like a death trap of just like a dodgy lender. So I'm going to use those words, a dodgy lender. And I know they're all verified and stuff, but isn't this a bit scary?
it definitely is. So, and that's the reason why we're saying it's always open to speaking with your children, seeing what other options there are. But really, sometimes to support your need in retirement, you really do need to unlock some of that equity within the property. So it's really weighing up against what does my lifestyle in retirement look like and how do I want to live my life? What do I want my financial legacy to look like versus this is the option of accessing a reverse mortgage. And definitely that's where I'm saying I potentially should have put another slide in here to show the Centrelink option. Accessing the cash flow of the Centrelink side of things, it's definitely better than this option here where you're looking at 628,000 from 150,000 borrowed. We are looking at a 15-year time frame here though, so it is
Yes.
it is a significant period of time. And I guess that's where for me personally, when I'm looking at it for my clients, it's either I'm looking at the Centrelink option because you just do not rack up the debt as much as this reverse mortgage option, or the home reversion where you're selling off a percent. So let's say you sell off 20% of your home to access 150,000 and there's no debt. You're just selling off that portion of the home, and the home reversion scheme is they're going to access some upside on the growth of the property in the future.
So they're going to get a certain percentage, and the property will increase in value. But on this reverse mortgage calculator, you can see that the home equity is just, you know, over 15 years, it's flatlining, which means it's going backwards.
Yeah, you're going to end up in a negative.
You get somebody with a percentage, and it's like, well, yeah, but we both benefit. Right.
That's exactly
but this reverse mortgage calculator, I look at this and I think this just doesn't look okay to me. It just doesn't.
Yeah, it's definitely not in the favor of the person with the home, but does it improve your lifestyle? Does it meet the need that you're after? But I'm always just personally from my own advice to clients, it's either the Centrelink or the home reversion scheme are the most favorable pillars compared to this reverse mortgage in the middle. But it's really just what suits your need. And yeah, it's scary. Those numbers are scary where we're looking at your home equity at age 80 only owning 60% of your home, where had you gone down the home reversion scheme, you potentially could have given up 20%. Yes, that 20% could potentially grow by multiplying the 3% growth on top of that.
But so will your 80%. Yeah.
Yeah.
It's a really good chart. Thank you very much for sharing that.
That's okay. And the Money Smart website, you can do different scenarios on there. So they do have the home reversion option. They do have receiving income regularly. So I'll take feedback on that I should have maybe added some different slides to make the other two just show the equatable differences. But it's always cash flow versus lump sum needs. But generally, if you could get away with cash flow and maybe saving for a period of time, then the Centrelink pension loan scheme is always, I say, the most favourable option, just considering the interest rate on it as well.
Okay, well, if that's what you thought of recommending at the end of this is great. Thank you very much.
That's okay. Thanks, Sarah. Okay, so we will move to what is a family home guarantee. So these are where parents can use their property to help their children enter the loan market. So this could be children who have owned homes in the past, onto second marriages now, divorced, or it can be first home buyers as well. So what the family guarantee loan allows you to do is it allows the borrower to, one, avoid lender's mortgage insurance. So that's lender's mortgage insurance is a lump sum payment charged by the bank. in case the borrower defaults. So the insurance is not on any part to the borrower. It's a security that the bank takes and charges a premium for. So generally, if let's say you're borrowing 700,000, and you don't have a 20% deposit, let's say you've only got a 10% deposit, you're most probably looking at around 10,000 in lender's mortgage insurance. So if you are able to use the family guarantee, it does allow a lot more flexibility for the children to access a property. It also actually allows them to borrow up to 100% of the property costs plus stamp duty and legal. So if your children don't have any savings at all or very minimal, the family guarantee loan does allow you to borrow 100% plus stamp duty plus costs. Most lenders would like to see that if the borrower if they're renting, so they would classify that as legitimate savings that they would be able to support the mortgage. So generally that always looks good on an application if they have been renting. It helps to act towards genuine savings. On the guarantor's side, you can nominate a specific amount that you want to guarantee. And you're only ever going to guarantee up to 20% of the loan. So it's referred to as a limited guarantee. You're not guaranteeing the entire loan, but you can nominate less. So if you wanted to only nominate guaranteeing 10% of the loan, you can do that also. With most lenders, they actually only allow you to guarantee an owner-occupied property for the borrower. So what that means is, generally, you can't family guarantee an investment property for a child, but there are some specific lenders that allow you to do that for first home buyers. So someone that hasn't owned a home in the past, they will allow you to be limited guarantee for that person to purchase an investment property. So let's say like they're living at home, they're not ready to move into an owner-occupied property yet. They wouldn't be able to service the debt on an owner-occupied property, but they still want to get into the market, then this may be an option for them, because obviously the first home guarantee schemes aren't available to investment properties as well. So the family guarantee loan may be an ideal option for a child that wishes to continue to maintain renting where they want to live, but wants to start building a financial foundation for themselves by way of an investment property. And using the family guarantee option may be a great start for these children. Always comes with risk, so you are required to get your independent legal advice when a guarantor is going down this path. The big thing is that you're limiting the guarantee of the amount. So it's going to be 20% if that's the amount that they're not being able to put forward on the loan. Or if you're doing the full 100% plus stamp duty, then it'd be the 20% plus the costs on top of that. As I said, there have been some exciting changes in the first home buyer scheme. So the federal scheme in the past was the government would help with, so these are for owner-occupied first home buyers or people who haven't owned a property in the last 10 years. So the federal government schemes allow previous homeowners who haven't owned a property in 10 years to also take part in this 5% deposit scheme, no LMI. The government offers security over the additional 15% remaining. So the current rules for the first home buyer guarantee is the 5% deposit. They have 35,000 places a year, and there were income limits. So 125,000 for singles and 200,000 for couples. And it used to go on your tax return for the previous financial year. Effective the 1st of the 1st, 2026, the Labor government have announced that you can buy with the 5% deposit scheme still, but they've removed the place cap. So there's no place limits now. They've also removed the income limits, which were very restrictive. Like it was a very narrow field on who could utilize this 5% deposit scheme. So these are some really great moves and changes and will really assist some first home buyers get into the market. So they've also increased the property limit for the use of the 5% deposit scheme. So the current limits, New South Wales capital city, is 900,000, where from the 1st of the 1st, 2026, the limit will now increase to 1.5 million, which is really, really good. The only clients, like buyers, will still have to pay stamp duty on that. So we do have some stamp duty concessions which don't align with these. So obviously buying a property for 1.5 million, you're looking at stamp duty of around 60,000. And then your 5% deposit scheme as well. So you're most probably needing to have savings of around 150,000 to enter into the scheme. But I still think it's very achievable, and with the income limits and the place caps removed and the new property price limits, it just opens the space up for a lot more people to be able to use this now. And obviously the 10-year ownership is rule as well, where people have been through divorce, sold properties and haven't been able to use these new first home buyer schemes. It just really opens up the space for a lot more people to be able to access this without needing to potentially go down the family guarantee line. They can just buy a property on their own. This one is open to only owner occupied, so it's not for investment properties. You do have to live in the property for 12 months within the first 12 months of buying the property. And then after that, you can do as you. While you sit under this 5% deposit scheme, it has to remain as an owner occupied property. You can move out of the scheme once your property grows in value and you're no longer sitting within the LVR bracket of 20%. So you can move out of this type of scheme. But while you're under this scheme, it has to remain as an owner occupied property. And then just some state-based grants. So each state has their own grants, new builds, stamp duty concessions. There's a lot of finer details with these, so I haven't actually put them on the slide, but I do have a handout that I will email with the slide deck to all attendees that the MFAA have put together, that just includes all the grants, state by state, what the concessions are, what the eligibility requirements are. It's just, there's a lot. There's so many different like brackets and regional and it was just too much to put into a slide. So I will share the handout when we share the slide deck as well. Now, that's it. I think, sorry, it's not going for as long as our hour that we've allocated, but did anyone have any questions on the first home buyer grant or the guarantee scheme at all? Just pop your hand up if you have any questions at all for them. That's correct, Scott. You do need to be over 18 to qualify for the schemes. Okay, perfect. So
Well, thanks, Jackie. That was, thanks, Scott. Thank you very much. That was really informative and very well presented. So thank you very much. As I said, we'll send a copy of this slide pack out and Jackie will include the flyer on that more detailed information. But if you've got any other questions or something you'd like to ask, just email Jackie straight away. You can see her email on the slide.